Hey, welcome to another Jazz After Dark. It's actually really dark here. It is quite late at night, but I'm enjoying making these videos here at home. And we never did the COVID thing. You notice during COVID, everybody went to work at home, but we're a family-run business and we video everything from the office. So we just kind of kept going to work, and we had it a little bit better than most states from what I heard out there. We're going to talk about some interesting stuff tonight. Tonight I actually, can you see it? Oh, hey. Wow. Look at that. Yeah, my wife has been working on some stuff for these shelves here, actually, but I didn't notice that. I had to break open the Buffalo Trace. If you don't know, Buffalo Trace, if you're a fellow bourbon drinker, bourbon, whiskey, scotch, whatever you like, this is like gold down here. It comes and then it disappears, and then it comes again, and then it disappears. And so very lucky to have that. That's one of my favorites. Probably up at the top, right? Maybe you go Weller, but Buffalo Trace for sure. So hang out with me, grab a drink, and let's learn something. I got really, really geeky data to share with you here today. And this actually comes from a class that I did for clients as well, but the data becomes relevant again because of what's going on. We want a recession at this moment, right? If we could label this a recession, which we can't because we're in between the quarter and everything, but if you could have a recession, I want you to know that you'll live through one, you're going to have this and everything. But man, if you could get the best of every world right now, you'd be like, okay, call this a recession, baby. Why is that? Well, remember, recession relates to the economy. Bear market, bull market, all of that relates to the stock market. They're two different things. And so a recession doesn't mean markets go lower. It means that they probably did go lower, right? And they're in the middle of having a bad time. But when we start a recession, that's a backward-looking data point. We need usually we need 2 consecutive quarters of negative GDP, and they throw in some job stuff here and there to decide, I don't know. But that's a lagging indicator because we need to have the quarter first, find out negative growth, then have another quarter, find out negative growth. And so we're looking back in time and saying, oh yeah, wow, we're in the middle of a recession. So the stock market tends to respond ahead of time. I'm not going to waste your time here tonight. We're going to dive right into this, and I'm going to explain this, right? Because there's a really, really cool thing to look at here. So hang on. You might need a drink for this one because this is going to slow you down. By the way, one of my favorite things to do, you think like, oh, Jazz Wealth, it's a name. I really like jazz music. I don't know if you can hear it in the background, but when I come home, I like to we have a refrigerator. We didn't buy like the Sub-Zero refrigerator or whatever. I bought the refrigerator that has a computer on it. It's got like a screen, and you can go on Spotify or Pandora, and I put the jazz on. So you may hear it in the background there over in the kitchen. And this is my favorite thing to do, just start cooling down, So I got it going there. I'm real happy with that. But yeah, you're going to need a drink for this data. You ready? All right, here we go. The question we're asking is, if we're in a recession and it's a lagging indicator, we probably know the stock market fell. So how far through the recession do we have to get before the stock market bottoms? Because if you followed for a while, stock markets bottom during the recession. They don't bottom after. They usually don't bottom before. It happens during a recession. And so a while back, we did a class for clients, like this is the class. And I thought, can we measure what percentage of the recession was done by the time the stock market bottomed, and see if we could put anything there? Is it 10% of the way through and then there's more nastiness, or what is it? So let's take a look here. All right, the first thing I'm going to do is I'm going to let you pick up your glass and drink, because you look at this data and you go, oh boy, that's a lot of data. Let's just go through it. I'll tell you what all this means one by one. So on the left, we have the actual dates of the recession starting in 1945. I didn't include the 2018 one because that was just a couple days. But every recession going back to World War II. Here's the dates, and they go in line, right? Next, we have the date and the week the recession started. Right? So we're looking back to see, like in this case here, the date the recession started was inside of what ultimately was prior to what was the ultimate date. So the date and the week it actually started, and if it was backwards, then what I did is I just put a negative number, and if it was right after, of course, it's a positive number. Next, we have the date that the market actually made a new low, right? And what was the drop? So in 1945, the date, March 26th, market made a low, and from the highs to that low was about a drop of 7%. Okay? Then over here, I say, well, what percentage were we into the recession, right? Right here. What percentage were we through? So this is, notice, the recession started on February 28th, 1945. We come over here. The low in the stock market was March 26th. Right? So we were 11% of the way through the recession when we hit a bottom. Make sense? And then over here, we talk about from the bottom to the end of the recession, what did the stock market do? Right? So, I made a slide for that. So from the end of from the bottom of the market through the end of the 1945 recession, the stock market had gained 24.3%. The big takeaway here is you don't see any negative numbers, do you? So from during the recession, the stock market bounced, and when the recession was over, we were already up 24%. Okay? So let's go back to the full slide here. In 1948, we had a recession. The stock market bottomed 58% of the way through the recession. Had to wait a little bit longer for that one. And from the low to the end of the recession, we gained 18%. In other words, if you were to say, I don't invest during recessions, in that case, you missed out on 18.4%. In the 1945 case, you missed out on 24.3%. Can we assign some averages to it? We can. So on average, the stock market the bottom of the stock market happens about 50% of the way through a recession. Some better than others, right? And from that bottom to the end, the official end of the recession, 24.2% is your bounce during that time. Now, in some of the cases, right? So like here, so remember, this is from the high all the way to that bottom. The bottom happened 62% of the way through the recession. So this was a nastier recession. And if you lived through it, then you're familiar with that. So this one took a while, but the drop was 51%. So we know from our classes earlier in the week, if you were hanging out with me there, bouncing 22% is nice, but that's not going to move the needle for me. If I fell 51% and maybe I invested somewhere near the top, you know from the class that we just did that, well, if you lose 51%, gaining 20, this is not adding up, right? However many drinks you've had tonight, you know those numbers don't add up. So that's that part of it. But look what's interesting here. The average drop is 24.8%. The average recession bounce is 24.2%. The median drop is 20.6. The median rally happens to be about very close, 24.1. What does that mean? If you look at the fact that you're going to live through, me and you, we're going to go together, we're going to live through many more recessions. Number one, if you know that, right, it's not so bad. You get it in your head. But if we know we're going to live through recessions, we're going to eventually play out somewhere along the averages. Kind of like the stock market or the S&P video we did yesterday, where the average return is about 7%, but we hardly ever see 7%. Well, me and you, we're going to be investing long enough where we're going to see that average play out, hopefully a little better. Take the same thing for the recession. We're going to have some bad ones where it falls more than others, and we're going to have some that are not so scary. But we're going to average 24%. Now go over here. From the bottom to the end of the recession, what happened? If you're in the recession, and you're playing along and you're grinning and bearing it, so to speak, but if you're in the recession, you're going to have recovered, not all of it, but you're going to have bounced, because we know if you lose 25%, gaining 25, that doesn't make you whole again, right? But you're going to have recovered most of it. And so if you say, I don't like a recession, I don't want to invest in it, okay, that's your choice. But it's essentially like you're walking away from what could be you buying a discount, playing along, getting some deals and stuff in there. So I really, really thought this was a cool thing to show, because this is the first time that I'm aware of that anybody's ever said, what percentage of the way through the recession did we mark a bottom? So it's about 45%. In other words, if you were to say recession, there's the beginning and the end of a recession, you don't even have to wait until it's halfway through until you've bottomed in the market. Again, stock markets bottom in recessions. Not once did we see a negative number here. That would have meant that it didn't bottom during the recession. So you gotta play along with that. I get it. I stopped really watching TV. That's why I make so many videos and I'm always working and stuff. I don't watch TV. But I stopped watching because you could really and quickly get the feel that this time is the worst time ever. And why? If you're young enough, the next recession, that will be, oh my God, this is going to be the worst one ever. You notice that? That's kind of frustrating, right? Because how could every one of them be the worst one ever, right? Well, it doesn't make sense. So, it's emotion. You start feeling that. But when you have the data and you say, look, I'm 40 years old, I'm 50 years old, I'm going to live through many, many, many more recessions. If I average that out, then it's really not hurting me that much. And I know to expect a bounce during a recession. So there you go. Kind of a simple one here tonight. Like I said, it's late. I just wanted to think of something that was relevant to what's possibly going on in 2023. And now you know. Just tell me what you think. Do recessions scare you? I always sort of think of the people on the roller coaster. After you go on a roller coaster and they try to sell you the shirt and stuff, and it says, I survived the whatever the roller coaster is. You should make a stock market shirt. I survived 2020. I survived, you probably wouldn't want to say I survived COVID, but I survived 2018 or 2020's decline. I survived May 10th, 2010 flash crash, right? Think of all the things. You're earning your stripes as you go. How do I remember these dates in my head? You lived through them. You've been a part of it or you studied it, and you realize that, it wasn't really so bad. One of the worst ones on record was 2008, 2009, the recession there, 62% of the way. It took all that time for the stock market to bottom. Okay, that was a bad one, right? That was really a scary time. So there'll be another one, and it's going to happen, and how you're prepared mentally, emotionally, and monetarily makes all the difference in the world. All right, well, if you enjoyed this, cheers. I hope you have a good night out there. Tell you, if you're looking to have a better night, Buffalo Trace goes really well with an Arturo Fuente double chateau. If you happen to be of a stogie mindset there, very, 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 very good complimentary, thing. I don't know how you say that, what the word is, but you guys enjoy the rest of your evening. Thank you so much for hanging out with me. If we keep doing these and it seems like everybody likes them, probably just do them live. If I could figure out how all this stuff works up here, maybe we could just do it live and hang out and do some Q&As and stuff. What do you think? You in? You want to do it? Yeah, it sounds like a good deal, huh? Adios.